This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Howdy, everybody. Thanks for tuning in. I'm Mike Mansfield. Man, it's been a busy couple of weeks. Obviously, we made a video last week touching on some of the Fed rate stuff, Fed rate cuts. Even data has evolved since then, which is always entertaining. But the show today, the good, the bad, the ugly. I want to start out of the gates here, though, with Palantir. Over the last month or two, I've had a lot of conversations with clients specifically about Palantir as a company, as an investment. Palantir is listed as one of the top 20 largest U.S. tech companies. They focus on software that has big components with AI kind of stuff. And so all of the sudden, what happens? Palantir, let's see here. Let me go to the chart. This is the 6-month chart. So Palantir as a company was grinding higher, doing pretty well. And then something happens, right? They crater about a week ago, lose about 25% of their value. Honestly, a lot of this feels like self-fulfilling prophecy. This put a little angst in the market. It kind of created a little larger scare where you saw a softening, a pullback in a lot of the big tech companies, the Magnificent Seven, as they call them. But what's going on here? And the question is why haven't we owned this stock lately? And that's where the debate with clients has come in. And I wanted to put some data up here on the screen so everybody can see this here. This is just some information about just basic fundamentals. Remember, we don't just buy companies. We want to invest in high quality things that have purpose, have good valuations, have good fundamentals. Palantir is a company that offers a great service, a great product, but we still have to consider fundamentals. And so I just put a handful of tech companies up here, all the big boys you've heard of. You've heard of Apple, Microsoft, NVIDIA, and obviously Palantir. And there's two adorable columns here. I should figure out how to highlight this. So in column one, why did that just go to a different size? What I have are trailing PE ratios. Geez, I'm undoing everything I did here to make it big. And so you see, like in column one, where it says trailing PE ratio, Apple is 34. What does that mean? What that means is there's two ways to look at it. But in simplicity, you take the current price of the stock, you divide it over the last 12 months earnings, and this is roughly, if their earnings stayed consistent, how many years of earnings you have to get into the future to justify today's price. So for example, Apple at the moment is 34 years. Now you have another column that says forward, and it's a little less. It's 28 years. The forward is saying, what do people think Apple's earnings are going to look like over the next 12 months? Therefore, how many years of earnings would you be buying based on that? Well, there's a lot of speculation in there. Now we're relying on analysts. We're relying on some kind of hope-so thoughts. When the number goes down, what that means is people expect Apple to make more money over the next 12 months as net earnings and revenue versus the last 12 months. You kind of see Microsoft, very similar. Trailing PE ratio, 37 years. Forward PE, 33 years. NVIDIA, Microsoft and NVIDIA, these are $4 trillion companies. These are the biggest boys in the herd. NVIDIA, you're paying a little over 50 years of earnings. And then we get to pesky old Palantir. This is actually an average. If we go to like CNBC or stock charts or somewhere, it says their trailing PE ratio is about 540 years, which to me, as I've said to many people, is clinically insane. You go back a month or two ago before their last earnings report, their trailing PE ratio was 700 years. I don't know about all of you. I'm not going to be around in 700 years to see if this plays out well. You also see that the forward PE has dropped dramatically. It's 250 years. Obviously, it's a huge improvement from their trailing, but the expectation here is saying that we think this company is going to do really well. We think they're going to make a lot of money. In fact, their last quarterly earnings were fantastic. They made over $1 billion in the quarter, which was great. But still, even off of the hopes and dreams of them growing as a company and growing their earnings, you still need to buy 250 years, a quarter of a century of earnings to even begin to justify the hopeful math. Me as an investor, honestly, I focus on trailing. And why? Because this is reality. That's what's happening with the company. It gives us a very good basic understanding. What is the forward? The forward is hope. I'm hoping an analyst is right. I'm hoping the market holds up. I'm hoping people buy stuff from these people. And, when you're an investor, you want to deal a lot more in reality than just hoping things are going to play out. And so the reality is Palantir got punched in the tummy because it was dramatically overvalued. It's still dramatically overvalued. And some things need to change. Either the price needs to come down or their earnings need to come up. But how is it that, NVIDIA, things up 1,000% in the last 3 years, and you're still only 50 years out? Obviously, very dramatically different math. Guess what? That's why we own these first 3 stocks, but we don't own that last one. In any case, just want to give some context there for everybody. So kind of getting into some of the good, the bad, the ugly. One of the things that's interesting is we track earnings, right? Very important to us. Second quarter earnings have wrapped up. For the most part, it looks like average year-over-year growth on those earnings are 11.8%, which is fantastic. This is 3 consecutive quarters of double-digit earnings. This is what we need to sustain and support, certainly the stock market at its current valuation. So very happy with that. But what was interesting is the information that comes from the phone calls. So when the CEOs and the top execs have the call and give out all the data, all the projections, look at this headline. From first quarter to second quarter. So this is just 3 months apart in these phone calls. There's an almost 90% decline in large companies citing the word recession in the S&P 500. Remember in the first quarter, recession, doom and gloom. It is all over. The market's going down. The end is near. And now all of a sudden, all of the big companies that have the tea leaves, right? Remember, they have all the consumers. 70% of our economy is consumers spending money, which is all manifested through these S&P 500 companies, certainly in part. And these companies behind the scenes are saying, hey, you know what? We're not as worried about that word recession anymore. Like, that's a pretty dramatic shift. Now, conversely, we can take that in another direction. Last week, I was talking about rate cuts. And what we talked about is we use the CME Rate Watch tool. And what I had said last week was, oh my gosh, look at this. And I know it's hard to see here in the screen, but down here a month ago, there was only a 56% chance that in September there would be a rate cut of a quarter point. A week ago, when I made the video, that had skyrocketed to 92%. We're like, wow. And the reason it skyrocketed, as I talked about last week, was, oh my gosh, all this labor, all this employment data came out and it's really poor. It's really soft. That is not very helpful. Hence the dual mandate of the Fed: price stability, labor market. Well, if labor market's falling apart, there's a great reason to start cutting interest rates. Obviously, there's some secondary ones that I'll talk about in a second with the national debt. Then, since then, we had PPI, producer price index, came out a little hot, hensing some inflation, concerns of tariff stuff. And so even in a week, now the probability of that rate cut has gone from 90% down to 70%. It's still leaning that way. The probability is still high. But then this morning, the Kansas Federal Reserve president came out and, he was on the news being interviewed and basically said, hot diggity dog, what's the problem? Interest rates are great where they're at. What is the point of cutting? Inflation is still sticky. It is still hot. So let's not worry about it. He, in my opinion, didn't address the labor market issue at all that suddenly perked up from the misreported data. So it's going to be very interesting in the next few weeks as we go into that Fed meeting. When is that? It's on the 17th of September. So, in 3 weeks, we'll see what happens. Now, same exercise. What is the issue? What is going on? Why is this interest rate thing such a debate? And so much of it at this point is about our national debt. We have a massive year. We're refinancing and reissuing, $11 trillion or something like that. And so our national debt has skyrocketed. It just hit a total of $37 trillion. That's a pretty big credit card bill. Obviously, very problematic of how we manage that. Let me see here if on this one, I'm on the federal government's website. Everybody can go here, but this is an interesting chart that they show. This shows what is the current interest rate at on the average of the debt. And so right now it's averaging internally at 3.32%. Now you can kind of see here on the chart, I go back to 2021, it was only at 1.61%, because remember, interest rates in that time period had collapsed. They're refinancing debts, they're restructuring and bringing this stuff down. That was very sustainable, and it's doubled since then, obviously, in just a few years. But remember, the problem is the Fed funds rate is still sitting at 4.5%. Well, if the average debt that we have is at 3.3, that's still a pretty big disparity, right? That's over 1%. And so as we're refinancing this debt that's coming due, this number is going to continue to skyrocket up. And we're already spending over $1 trillion a year on the interest, which is buried on here somewhere. Now that's the debt, right? That's the total credit card bill. The next question kind of gets into, well, how much are we adding to the credit card bill? And that's our deficit. So now we look at our annual spending. Our annual spending in really round numbers, we're bringing in about 5 trillion of tax revenue. We're spending about 7 trillion. So we kind of hover pretty darn close to this $2 trillion deficit number. So if you go to the government's website, the treasury.gov, here's the national deficit year to date through July. And so it's at 1.6 trillion. Remember, our calendar year ends in September, so we're almost done with the year. And what this tracks is, even though it's subtle down here, is it shows year over year. So if we read this small line right here, it says October of 23, remember the calendar year starts October, through July of 24. So that's last year. We were at 1.5. And this year we're at 1.6. So we're a little over $1 billion higher year over year. Now, ironically, because our GDP has increased as a percentage of GDP, it's actually softened a little bit. Not great math, not something we would want to rely on as some value. But ironically, being only $1 billion up is not terrible all of a sudden if anybody had any perspective. I watch the news all day long. I've got CNBC running here right now. They're talking about how September tends to be a garbage month in the stock market. Now I'm turning back to you guys. Bipartisanbudgetpolicy.org. They do a deficit tracker. Now they've got a lot of years on here. I wish I could drop off some of them. But what my focus is on this chart is year over year 2024 and 2025. So you see at the top, we got a green line and a purple line. And so if I hover over them, so the purple line this year, there's that 1.6 I just showed you of our national deficit, whereas last year it was 1.5. So those two little bubbles are really close to each other. But maybe we should go back. Let's go back to October. At the end of October to November, that's 1 month into the new calendar year. And so if we just look at the deficit back then, last year, 2024, we were at 380 billion as the total deficit, whereas this last year we're at 600 billion. Whoa, that's a massive increase in just the first month of spending. We go to month 2. The deficit, the previous deficit was 500 billion. This year it was 700 billion. There's a $200 billion gap just in the first 2 months of the year. Remember, we're only at $1 billion right now, or 100 billion. So we've been slowly closing these gaps. We go to January, 500 billion the previous year versus 800 billion. Massive increase, right? And we've closed that gap. Now there's some irony here that, there's a lot of criticism with the administration, how they're addressing taxes, how they're addressing deficits, how they're addressing debts. And I find that some ironic criticism that we suddenly care about these things as of January 20th this year, but nobody cared in January 19th of this year, because the deficit skyrocketed last October through January. And then we've been clawing it back, trying to tighten this whole thing up ever since. And we've tightened it up quite a bit. We're only 100 billion in disparity. Different presidents, different administrations, different goals, different spending policies. So I think that this is an interesting year as we track the national debt to get a good understanding of how new policies and new attitudes are really affecting it. Honestly, it is nice to me that we see these two numbers closing the gap versus widening. So that's not a massive indication to me that things are spiraling out of control on a further basis at the moment. But we're going to see what happens. I mean, that's the problem with a new administration and new policies is we're almost living in the moment where this is all theory, right? We don't quite know what's going to happen yet. New people are putting new things in order. As those balls start rolling, we'll find out in a few years if they're effective or not, and that's the unfortunate part of hindsight policies and hindsight investing. So anyways, a lot of data here. Appreciate everybody watching. If you got any questions, concerns, give us a call, 805-500-7035. Certainly visit our main website, thelindgroup.com. And everybody, have a great day.